As the U.S. markets are currently closed, Qualcomm Incorporated, trading under the ticker QCOM on the Nasdaq, finished Friday's session, October 10, 2025, at a price of $153.52. Many investors see that price and immediately anchor their thinking to the global smartphone market. The common narrative is straightforward. Qualcomm's fortune rises and falls with the number of Android phones shipped each quarter. That's the expectation. The reality, however, is that fixating on handset sales is becoming an increasingly outdated way to value this company. The critical data points that will define Qualcomm's next 5 years are not coming from smartphone sales figures, but from automotive design win pipelines and the company's aggressive push into next-generation personal computing. The market sees a component supplier. The underlying business is transforming into an infrastructure player for mobility and artificial intelligence. And this disconnect is where the real story lies for anyone looking to invest online. Most people managing their portfolio, whether it's through a self-investing platform like Fidelity or a more guided service like Schwab Intelligent Portfolios, have been conditioned to see Qualcomm as a proxy for the health of the high-end Android market. For years, that was a fair assessment. Their Snapdragon chipsets have been the beating heart of flagship devices from Samsung, Google, and a host of Chinese manufacturers. The licensing division, QTL, has been a cash printing machine, collecting royalties on the fundamental 5G patents that every single smartphone maker needs. So, when you see the Qualcomm stock ticker on your SoFi Invest app, the immediate mental connection is to phone upgrade cycles, consumer sentiment, and competition from rivals like MediaTek. But sticking to this view is like trying to drive forward while looking only in the rearview mirror. The assumption is that growth must come from selling more phone chips or signing new licensing deals. The truth is that the most significant future revenue streams are emerging from segments that were considered peripheral just a few years ago. Let's examine the stock's recent behavior. Over the past few months, Qualcomm stock has shown periods of volatility, often moving in lockstep with the broader semiconductor index. However, there have been noticeable divergences. On days when negative news about smartphone demand hits the wires, QCOM might dip, but it has often found a floor quicker than one might expect. Why? Because institutional investors, the ones using sophisticated platforms like interactive brokers for their trades, are looking past the quarterly handset noise. They are modeling the growth of the automotive segment. In the last earnings report, while the handset division posted modest single-digit growth, the automotive segment grew by double digits. This is not a one-off event. It's the continuation of a clear trend. The company's automotive revenue pipeline is now in the tens of billions of dollars, representing long-term, locked-in contracts with major car manufacturers. This is a fundamentally different type of business. Unlike the fast-moving, high-turnover consumer electronics space, automotive design cycles are long. A design win today means guaranteed revenue for the next 5 to 7 years as that car model is produced. This provides a level of predictability and stability that the handset market simply cannot offer. This is a crucial detail for anyone looking for investment help, as it changes the risk profile of the company. This shift is central to understanding the stock. The market is still applying a valuation multiple that reflects the cyclicality of the smartphone business. Yet, a growing portion of Qualcomm's future earnings will come from the far more stable and predictable automotive sector. What does Qualcomm actually do in a car? They are the architects of the digital chassis. This isn't just about providing a 5G modem for connectivity. It's the entire digital cockpit, the instrument cluster, the infotainment system, and the advanced driver assistance systems. They are competing directly with giants like Nvidia and Mobileye to be the central brain of the vehicle. Every time you see a new electric vehicle with a massive, responsive touchscreen and sophisticated navigation, there's a high probability Qualcomm's Snapdragon Digital Chassis platform is running it. This is a much stickier, higher-margin business that many retail investors, perhaps making trades on the Robinhood app, might be completely overlooking. Now, let's briefly touch on the core business for those unfamiliar. Qualcomm is structured around two primary segments. The first is QCT, or Qualcomm CDMA Technologies, which is the semiconductor business. This is where the Snapdragon chips are designed and sold for mobile phones, cars, virtual reality headsets, and now laptops. The second is QTL, or Qualcomm Technology Licensing. This division manages the company's immense portfolio of patents, particularly those essential for 3G, 4G, and 5G wireless communication. Any company that makes a device that connects to these networks has to pay Qualcomm a royalty. For years, this has been a source of immense profit and significant legal battles, most notably with Apple. However, the recent signing of a long-term patent license agreement with Apple through 2027 has removed a major overhang of uncertainty from the stock, ensuring that this high-margin revenue stream remains secure for the foreseeable future. This stability in the licensing business provides a solid foundation of cash flow that the company is using to fund its expansion into these new growth areas. You can find all this information in their quarterly filings, which are essential reading for anyone serious about self-investing through their individual brokerage account. Looking ahead, the landscape presents a fascinating mix of opportunities and risks. The biggest catalyst is the aforementioned push into automotive and the adjacent field of AI-powered PCs. With the Snapdragon X Elite chip, Qualcomm is making its most credible challenge yet to the Intel-dominated PC market and is positioning itself as a key partner for Microsoft's vision of next-generation AI PCs. This opens up a massive new total addressable market. Success here would fundamentally rewrite the company's growth story and force a significant re-rating of the stock. Another major opportunity is in the Internet of Things, where their low-powered connected chips are being used in everything from industrial sensors to retail point-of-sale systems. It's a fragmented market, but Qualcomm's scale gives them a significant advantage. This is the long-term vision, moving beyond the phone to a world where everything is intelligently connected. However, the path is not without its obstacles. The most significant risk is geopolitical. Qualcomm, like the entire semiconductor industry, is heavily reliant on Taiwan's TSMC for manufacturing its advanced chips. Any disruption to that supply chain, whether through political tensions or other factors, would be catastrophic. Furthermore, a substantial portion of its revenue comes from Chinese companies. An escalation in the US-China trade war could severely impact its business, either through direct sanctions or by encouraging Chinese firms to accelerate their development of domestic alternatives. Competition also remains fierce. In the automotive space, Nvidia is a formidable opponent with a strong position in AI and self-driving technology. In the mobile market, MediaTek continues to be a strong competitor in the mid and low end, while major customers like Apple and Samsung continue to invest heavily in developing their own in-house silicon, which could reduce their reliance on Qualcomm over the long term. These are the risks that any comprehensive investment thesis must account for, and they are actively debated by traders on platforms like Interactive Brokers and analyzed within the research reports available through services like Fidelity Wealth Management. I want to hear from you. The diversification story is compelling, but the smartphone business still pays the bills today. Comment below. Are you more bullish on Qualcomm's traditional phone business or their expansion into automotive and PCs? It's a core question for understanding the future of this company. In conclusion, the expectation surrounding Qualcomm stock is that it is a mature, cyclical company tied to the whims of the smartphone consumer. The reality is far more complex and arguably far more compelling. While the handset market provides a stable, cash-rich foundation, the true growth engines are now firing in the automotive and computing sectors. The market has not yet fully priced in this transformation. It still sees the old Qualcomm. The disconnect lies in valuing a company based on its past identity versus its future potential. The risk is that this transition takes longer than expected or is derailed by geopolitical events. The opportunity is that as the revenue mix shifts decisively towards these new higher growth markets, the stock will be reevaluated not as a simple component maker, but as a diversified technology leader powering the next generation of intelligent connected devices. The narrative you see on a simple stock trading app doesn't capture this depth. Understanding this gap between perception and reality is the key to making an informed